Hello everyone and Happy New Year. Have those three words ever meant more? I'm Mark Kinney, Chief Investment Officer of Newport Private Wealth with this fourth quarter and year-end update. I won't recap the events of 2020. You've already lived it once, and I don't think many people are anxious to repeat it. I will provide context for the market's performance last year and let you know what we've done to position client portfolios for success in 2021 and beyond. We invest across 11 different asset classes with the weightings and combinations determined by our investment committee. Specific investment selection is made by independent specialists that we retain and monitor regularly. From this investment universe, 2 asset classes delivered surprisingly strong returns that few would have predicted at the start of 2020. One was stocks, specifically U.S. stocks, and the other was bonds. A number of you have asked, how has the stock market been hitting new highs with virus cases escalating, millions jobless, and the economy and U.S. political landscape in disarray? And more importantly, how much longer can this rally go on? To answer the first question, the stock market is dispassionate. And remember, it is a leading economic indicator. So it looks beyond the present mayhem into a rosier future where the global economy reopens and vaccines bring an end to the pandemic. Another explanation is monetary stimulus by central banks. Low interest rates are like rocket fuel for stock markets because they make earnings more valuable, which encourages investors to pay higher prices for stocks. We've also had record amounts of fiscal stimulus, with more to come under President Biden. Stimulus has kept the economy afloat, and combined with the lockdown, saving rates have soared. This has put cash in the hands of a new class of speculative investors. As a sign of the times, trading app Robinhood posted 500,000 new account downloads in December alone. Day trading is back in vogue, and options use is at an all-time high. Up until the fourth quarter, unbridled enthusiasm for anything digital sent shares of tech companies soaring, and this has obscured true market performance. Did you know, for example, that Airbnb now has a market cap bigger than that of Hyatt, Hilton, and Marriott combined? Or that 77% of the S&P 500's 14% return in 2020 was from just 10 technology-related stocks. The remaining 495 stocks in the index returned just 4%. In Canada, the TSX returned a lowly 2% last year. Remove Shopify from the index, and it would have meant a 2% decline. Investors with a lot of Canadian equities didn't fare very well. Fortunately, our higher allocation to U.S. equities and superior stock picking by our external managers helped our North American equity fund beat the benchmark with less risk. I say that because our fund owned only one of the big tech companies, Microsoft, and yet it still managed to capture and beat the market rally. In hindsight, we would have done well to allocate even more capital to U.S. equities, but we always remember our goal is to not only grow your capital, but to protect it. There is no straight line or clear path as to how long the U.S. market rally will last. Easy money and massive amounts of cash on the sidelines should keep the rally going. And the consensus among analysts for 2021 is positive for GDP growth, earnings, and markets. But our experience over 30 years of market cycles tells us that when stock prices and expectations are this rosy, it pays to have a skeptical eye. Markets have already priced in a successful vaccine rollout and economic recovery. If this were to falter, there could be some downside. One thing's for certain, portfolios built with no appreciation for underlying fundamentals are ripe for correction, and those investors could get hurt. We feel good about our total equity allocation at 43%. It's enough to participate in a continued market rise, but not as exposed as having 60% equities as in a typical 60-40 balanced portfolio. If stock markets pull back, we would add to our position. We also feel comforted by our external managers' careful stock selection based on value and growth at a reasonable price, not growth at any price. As seasoned investors know, last year's winners are seldom next year's winners. The normal cycle of financial markets is that money is constantly in search of new opportunities as conditions evolve. Tech and growth stocks were the market darlings for most of last year. But in the fourth quarter and year to date, value strategies and cyclicals like industrials, financials, and energy have come roaring back. This sector rotation should continue through 2021 as the economy begins to recover its footing and life returns to a new normal. We also expect that Canadian and international equities will outperform the U.S. in 2021. We plan to reap the benefits through our global managers, including EdgePoint. EdgePoint owns market-leading international businesses with terrific growth prospects, bought at deep discounts, simply because they were out of favor or ignored by the market. In 2020, EdgePoint's portfolio had been down more than 20%, but rebounded in the fourth quarter to finish even as the sector rotation I just described took hold. Which leads me to an important principle for investment success. When people ask me, what's the best way to select a money manager? I tell them, pick a manager with a great long-term track record and a poor short-term record. If nothing has changed with their people or processes, it usually means they're about to break out. We are confident this will be the case with EdgePoint, given its outstanding 10-year track record and its investing discipline. Now I want to spend a moment on bonds because this is another area where I think a lot of investors have been underestimating risk. The bond index returned close to 9% last year, a surprising and exceptional rate of return that was directly related to the pandemic. At the start of 2020, 30-year Government of Canada bonds were earning a yield of 1.76% and finished the year at 1.21%, meaning bond prices went up. That's because when the pandemic hit, central banks lowered interest rates, causing bond prices to rise. They also stepped into the market as buyers, providing an underpinning of support. We can all grasp that when there is more buying than selling, prices go up. Canso, one of our bond managers, provided context for just how overvalued bonds have become using this comparison to dividend equities. Since bond coupons are fixed and don't increase, a 30-year Government of Canada bond yielding 1.2% translates to a price-earnings multiple of 83 times for a stock with no prospect of earnings growth. Scary stuff. The bull market in bonds has run for 4 decades and, as this slide shows, is now at an end. Interest rates are at rock-bottom levels and have started to rise this year. The only way bond prices go up further is if yields reverse course and head back towards zero. For all these reasons, we've kept a small 5% allocation to bonds because we have other asset classes that generate higher levels of income. Last year was an anomaly when bonds significantly outperformed our diversified yield strategy. But over the last 10 years, our strategy has outperformed the bond market across all 5 of our investment mandates, proving that diversification works. We think the next 10 years will prove out even stronger given how low rates are and how hard it will be for bonds to generate any meaningful return. Let me give you some examples of our diversified yield investments. We have a portfolio of private mortgages totaling 355 loans. All are current and paying as expected. The current yield is 6% and the mortgages were bought at a discount to face value, so they have a yield to maturity of 8.3%. The manager has done a great job of sidestepping problem sectors such as enclosed malls and hospitality. Our hotel exposure is less than 2%, and our retail exposure is primarily shopping centers anchored by grocery stores and pharmacies. Private debt is an alternative asset class we've been steadily building and are excited about the prospects for 2021. That's why, towards the end of last year, we committed another $80 million to private debt through 4 managers with whom we have a track record. Private debt is best described as bonds issued by private companies. Market conditions are particularly favorable right now, and we expect this asset class to outperform traditional bonds in the coming years. Yields are about 8% and not as interest rate sensitive. High dividend equities. When the market corrected in 2020, we upped our allocation to high dividend equities. This has already proven to be an opportunistic move. And as more and more investors seek higher income outside bonds, we expect this asset class will shine next year. Lastly, real estate. This offers one of the better values today, and we're excited about the opportunities we see here. Our existing portfolio of private real estate is well located, well managed, and well capitalized. In other words, highly resilient. News reports of falling rents have mostly impacted the Toronto condo market. Our apartment portfolio has not been affected in any material way. For both our Canadian and U.S. apartment assets, rent collections are running at approximately 98%, well above industry averages, and rent renewals are strong as well. During the fourth quarter, we bought another U.S. garden-style apartment block, a prize location property in an affluent suburb north of Atlanta that came available at good value. Public real estate is even more attractive from a valuation perspective. That's because global REITs got beat up so badly in 2020 and never fully recovered. Other than a few e-commerce focused properties, as this slide shows, most REITs were down significantly. Compared to global equities, REITs underperformed by nearly 25%, the largest discrepancy in 25 years. Our manager believes 2021 will mark the beginning of the great REIT opening, where REITs will deliver outsized returns. Low interest rates are propellants for real estate. And looking out a few years when inflation may rear its head, real estate acts as a hedge. We like this asset class a lot. We're optimistic about the future. We are also realistic there will be bumps along the way. Some we can't anticipate. Thankfully, we don't have to make big bets or bold strategy calls. We are well diversified and more than 80% of our investments generate income. We have the people and processes to review and exploit opportunities as they come available, always with a protect capital first mentality. In closing, we can never say it enough. Thank you for trusting us with your wealth. 2020 was a most unusual year, and if there are questions or themes you'd like to discuss that we didn't have time to cover today, I encourage you to follow up with your portfolio manager. We have more in-depth presentations on our viewpoint. Until then, stay safe, stay hopeful. There are brighter days ahead.